Hey everyone, welcome back. It's September 11th, 2025, and buckle up because we've got a massive day ahead. The U.S. Consumer Price Index, that's the CPI, our go-to inflation gauge, dropped at 8:30 a.m. Eastern Time, and it's shaking up the markets. If you're wondering how this affects your wallet, stocks, or even the Federal Reserve's next move, you're in the right place. This is gonna be a quick, no fluff breakdown to keep you ahead of the game, so smash that like button, subscribe if you're new, and let's dive into the numbers. First up, what's the CPI? It's like a thermometer for the economy, measuring how much prices for everyday stuff, groceries, rent, gas, you name it, are changing. Last month, July 2025, the CPI came in at 2.7%, year over year. Economists were expecting August to hit 2.9%, and guess what? That's exactly what we got. Headline CPI rose 0.3% month over month, pushing the yearly rate to 2.9%, up from July's 2.7%. Core CPI, which ignores volatile food and energy, held steady at 0.3% monthly and 3.2% yearly. So inflation's ticking up, but it's not running wild. What's driving this? Housing costs are still a big culprit, climbing 0.4% monthly. That's rent and home prices, squeezing budgets. Food prices at home nudged up 0.1%, but energy took a breather, dropping 0.2% thanks to cheaper gas. One wildcard: tariffs. They're starting to push up prices for imported goods like electronics and clothes, adding about 0.3% to inflation this month. That's something to watch as we head toward year end. Now, why does this matter? The Federal Reserve's meeting is just days away on September 16th, 17, and they're obsessed with keeping inflation near 2%. Today's 2.9% print is above that target. But it's not a deal breaker. Here's the deal. A higher than expected CPI could have made the Fed stay hawkish. That means keeping interest rates high to cool prices, which can spook stocks and boost the dollar. But since we hit the 2.9% mark right on the nose, markets are leaning toward a dovish Fed. Think rate cuts to juice up the economy. Futures are pricing in an 88% chance of a 0.25% rate cut next week, especially after last Friday's weak jobs report. Lower rates could mean cheaper loans for you and a potential rally in stocks. So what's the vibe in the markets? Stocks are holding steady for now, but volatility's lurking. If you're trading or investing, keep an eye on core goods, stuff like appliances and apparel, where tariff effects are creeping in. Bonds might catch a bid if rate cuts look locked in, but a surprise spike in inflation later this year could flip the script. Economists are forecasting CPI could climb to 3.4% by December if tariffs keep pushing prices up. Here's your action plan. Stay sharp for the next CPI report on October 10th, which will cover September data. Also, yesterday's producer price index dropped 0.1% unexpectedly, hinting at softer price pressures down the line. That's a clue inflation might not spiral out of control. For now, expect some chop in the markets as traders digest this and brace for the Fed's decision. All right, that's your CPI breakdown. Inflation's up, but the Fed's likely cutting rates soon, and volatility's on the horizon. What's your take? Will the Fed go dovish and spark a market rally? Or are we in for a bumpy ride? Drop your thoughts in the comments. I read every one. If this helped you get a grip on today's data, hit that like button, subscribe, and ring the bell for more market updates. Thanks for watching, and I'll catch you in the next one.